Welcome. My name is Van Richards. I'm a chartered financial consultant, and I'm here today to talk to you about a great company, Alibaba. Every day when we get together and I talk to you a little bit about a different stock from a company, I'm really trying not to focus on the stocks itself. I'm not telling you or teaching you how to buy stocks. I'm teaching you how to identify companies. And the company that we're going to look at today is not a domestic company that's here in the States, that's here in the Americas. It's Alibaba, which is it's a Chinese hallmark company. It's an incredible company. So without further ado and further delay, let's go ahead and get into today's daily stock analysis. Alibaba is a unique company in that it does things differently. When we talk about comparing it to another company that's here in the United States or another company that's anywhere in the world, we have to look at the approach that they take at the business. And in a moment, we'll talk about what the co-founder, Jack Ma, described the company as. But I think that it would help you in identifying a company to kind of get an idea of what this company does. You probably have heard of it, and you've probably also heard of it in relation to the IPO that was put off, or maybe you haven't heard. It was being created, which was a division or a part of Alibaba, which was called Ant Group. It's an interesting name, but we'll talk about that just a little bit more in a moment. But when we talk about trying to find different companies that satisfy you, that help you to build wealth, it's like making bread with a recipe. You know what goes into that bread. You know that there's oil and water and salt and yeast that goes into it. It's pretty simple from that standpoint. And what we're going to look at in identifying stocks is certain steps that you can take that will help you to identify what that company is and whether it would be a good company to add for your portfolio to help you build wealth. So let's go ahead and begin into looking at the individual stock in itself. And before I do that, I will remind you that if you want someone that'll help you build wealth, I can help you do that. If you live in Texas, that's where I do personal service. Go over to my website at richardsfinancialplanning.com and you can learn more about how I can help you build wealth if you need someone to do it. But today I'm going to show you how that you can do a lot of this on your own. Let me make the screen just a little bit bigger for us, and this will help you understand what Alibaba does. So let's go ahead and watch. 772.65 billion dollars. Now I'm sure it's more than that now because I took this number this morning and it's up about 3.55% for the full day. So it's actually done pretty well from that standpoint. But when we start talking about what you can do with these particular stocks, let's get over to this. When we talk about how the founders put the company together, that really helps you identify what the company does and if it's a company that you think that you would like to invest in. And when Jack Ma in an interview was asked about, well, how do you compare with other companies? Are you eBay? Are you Amazon? His answer was no, we're not eBay. We're not Amazon. We are an e-commerce company. I don't even think he described it like that, if I can recall correctly. He said we are the largest e-commerce company in China, but we're not an e-commerce company. What he described his company as is what you see it's in front of you. He said that we enable other companies to do e-commerce, and that's really what Alibaba does. Now, today, what we're going to talk about is 3 different things that'll help you identify whether this is a good stock for you or not. We wanted to discuss whether it's a stable company. We'll talk about the earnings in itself, and we're going to talk about how it competes with some of those other companies. Even though that Jack Ma said, no, we're not like Amazon and we're not like eBay. Well, we're talking about your dollars, and you need to understand how your dollars are invested, and could they be better used someplace else? Or is a company like Alibaba a company that you really want to look at? Now, when we look at companies in themselves and try to figure out what's going to work and what's not going to work, we want to use something that Warren Buffett came up with, and that's describing an economic moat. As you can see in front of you, this is what Warren Buffett says an economic moat is. He says, in business, I look for economic castles protected by unbreachable moats. And what he's meaning is this is the barrier between this company and another company. So let's take a look at what some of the economic moats are for Alibaba. If we look at it right now, the biggest thing that they've got going for them is that they are the largest e-commerce company in China. They have a very strong network. Now, the network effect is, it's very simple. The more it is used, the more it is used. In other words, you use it, your friends use it, their friends use it. It just gets bigger and it snowballs from that standpoint. They also have quite a few intangible assets. They have different proprietary assets, internal talent, and unique resources. And that makes it significant in working with a company like this and how that they are able to garner business and keep business. Now, when we do compare it to other companies, and we're trying to figure out how stable is this company and compare it to other companies in itself, we want to look at, let's bring up one at a time here. We have Alibaba, Amazon, eBay, and Mercado Libre. These are all four very large e-commerce companies. Now, if you look at the spaghetti graph, you can see, wow, in the past year that Mercado Libre actually did much more than anybody else. Well, is it a better investment than Alibaba? I would say this. It is a good company. And if you're looking for e-commerce companies, it might not be a bad idea to diversify. In other words, if you've got whatever amount of money that you want to put into an e-commerce company, if you think that's a sector that is interesting to you, is appealing to you, then perhaps don't just invest in one company. A good reason is that you probably heard, or you maybe haven't heard, that yesterday, actually the day before yesterday, the Ant IPO was pulled. Jack Ma got into a meeting with some of the regulators in China, and there was conversation that went on supposedly, and basically the regulators said, no, you can't do this. So there's a lot of back and forth that's going on. Will it go forward? It probably will, but not in its current form. There's probably a lot of information that has to be changed here. And I think that there's two things that really caused the Ant Group IPO to be pulled. One of them is there was a comment that Jack Ma made when he was speaking to bankers about overregulation from the Chinese government. And I don't think that that was taken very well, because some of the Chinese regulators were supposedly at that meeting. It could be some personal animus that's towards him, even though he's not really in charge of the company. He's a co-founder and he's very involved in it. Now, another thing that caused perhaps it to be pulled was the fact that there were a lot of people out there in China. A lot of people were borrowing a whole heck of a lot of money to be able to invest into the Ant Group IPO. There were going to be two of them, one on each exchange in China. And in that, I believe that what the regulators did is they looked at it and said, the Ant Group is actually loaning money so that they can buy stocks. And that's kind of a conflict of interest from that standpoint. And with the large amounts of money that were being borrowed, not just on margin through brokers, but through banks were actually encouraging people to take loans in China so that they could participate. That type of thing sometimes can backfire when we have something that's moving forward like that. So it may be that it comes out with a lesser valuation. Right now, Alibaba owns about 1/3 of Ant. Ant's IPO price is probably going to be around 300 million. So you could think that if the IPO goes forward, or when it does, about 100 billion, I said million, it's 300 billion estimated in its IPO value, that 100 billion of it would come back into Alibaba. That'll probably happen, not in the near future, but it's probably going to happen at some point in time. So let's go back to the slides, if we could, please, and keep going forward. If we look at the size of the company has a lot to do with the stability of it. Remember, the past performance is not going to be a guarantee of the future results. But let's look at the volume of this company in comparison to some of the other e-commerce companies that are out there. Just in 2019, Alibaba did a gross merchandise volume of $807 billion. Now compare that to eBay and to Amazon. If you add eBay and Amazon together, it still doesn't add up to the amount of volume of merchandise that was sold in 2019 through Alibaba. So is it a good company? Yeah, it's got a good foothold. And when we look at what some of the analysts are saying right now, these are what the bullish analysts are saying about Alibaba. The Chinese internet shoppers, the very first place that they go is the one division of Alibaba that's called Taobao. And they'll go there first when they're looking for something on the internet. And that's a really big thing. They have a lot, that means that the customers have a lot of faith and have a lot of loyalty towards Alibaba. Also, there are 711 million active buyers that are utilizing Alibaba. Now, here's a quiz question for you. What's the population of China? The population of China is about 1.4 billion people. So if 711 million of them are active users in Alibaba, then half the people in China are using Alibaba. That's a really bullish sentiment from that point of view. Also, the fact is that it integrates. If you remember the video at the very beginning, all the different divisions of Alibaba, they benefit each other. The different marketplaces, they feed off of each other, just like the Ant Group is a financial aspect of Alibaba, and hopefully it will be spun off to an IPO. But the idea is that it benefits from the other businesses that are there. So that's a significant benefit with Alibaba. Now, as you noticed, we talked about Ant, and just to remind me, I did put the Ant on the screen just to remind you about that too. We talked about it. The Chinese government regulation is a bearish aspect of Alibaba. You have to think of it this way. The Chinese stock market has really only been in existence for about 30 years. So it is a developing market. It's not as mature in its regulation as it is here in the United States. Some might say that's a good thing. Some might say it's a bad thing. But what it does is it gives circumstances like what we have seen with Alibaba being, actually not Alibaba, but having their Ant division or their Ant group put their IPO on hold because the government didn't have enough agreement with it. So that makes a big problem if you're thinking about investing in this company going forward. They also do have other competition that's in China. There are other e-commerce companies like JD.com. I've talked about that here on this channel just a little bit. There are other things that are outside that Alibaba invests in too. And if they are not as profitable as something like the Ant Group, it could pull away from the overall profitability of Alibaba. And if you go back and you look at that video, you'll see that there's actually 12 divisions of Alibaba in total. And then last but not least, as they try to grow outside of China, the culture in the country has a lot to do with the way that the company has grown. If you listen to what Jack Ma's description is, when he described the way that this company worked, he described it in this way. He said that he was aiming the growth of the company or helping to shepherd the growth of the company to focus on young people. And the reason was that the culture there, it used to be that if the older people basically told the younger people what to do. If you wanted to get married, you asked your parents. They helped you to get married. If you wanted to make a major purchase, you asked your parents. Well, as he pointed out, that has kind of changed. It's been kind of a paradigm shift in that now, if the children are participating in something, then the parents will too. And that's really the shift that we've seen. That type of cultural change is not as prominent, or it really doesn't exist in the United States. So if they're taking their business model and trying to plug it into the United States, it might not work as well here. It might not work as well in South America or in Europe, other parts of the world, that is. So the business model in itself does have a lot to do with the development of the company. Now let's look at the financials of the company in itself. Now I know that Alibaba, if you're listening to this on November the 4th, you'll know that, or you should know that November the 5th, which is tomorrow, they will have their earnings call. So we're a little premature in that. And the earnings in itself for the second quarter were about $21.8 billion. Now, what the analysts are expecting is $23.2 billion. So be looking to that. It's been pretty consistent. It actually was quite higher last quarter than it had been in previous quarters because of the coronavirus market crash. But it's moving forward. Also, if we're looking at what analysts are expecting with earnings per share, last quarter they were at $2.11 a share. Actually, that should be 210. That's a typo right there. That was at 210. They're expecting 211. And they've been pretty good. If you follow the graph, it shows you that they've been pretty good about either being over top of expectations or right on it from that standpoint. Okay, let's look at the valuation of it, because that's really important. Because if you are at this point, you've gotten to, I've encouraged you to think about it as a company that you want to put into your portfolio. You may be wondering, well, what's the best price that I could buy this stock at? Well, today it closed at $295.71, and Morningstar is saying that actually a fair price on this is going to be $285. So we're saying that Morningstar is saying that they're trading at about a 10% premium over top of what its value truly is. If we want to look at what other analysts are saying, whether this is a buy or a sell or a hold, the majority of analysts, 15 out of 16 that were polled, said this was a strong buy. So we just have to figure out where's the best place to buy it. Let's look at it over the past year and see what the price has done. A year ago, it was trading at $179.69 a share, and it's increased significantly over the past 12 months, 64.57% to that $295.71 that we saw today close at. Remember, though, the past performance is not going to be a guarantee to future results. Plus, you've got to go back and look at this and think, am I buying it at the right time? Now, I'm not going to tell you yes or no, but I want to spur thought in your mind about what's happened in the past. This is the past 3 years. If you follow the spaghetti graph, 3 years ago, remember what it sold at a year ago was only about 179, but 3 years it was 187. So it was actually higher 3 years ago than it was just a year ago. And then we finished today at 295.71. So it's an APR over the past 3 years. That's an annual percentage rate that if you get annually, just kind of describe that, of 16.33%, a total of 57.43% over the past 3 years. Now, what are the options markets doing on this? The all-time high on this stock has been $319. Remember, with options, you have calls and puts. Just a short little education in here. If you're calling something, if you have a call, it's a contract to buy. If you have a put, it's a contract to sell. And you pay a price for that contract. If you follow my dancing cursor, you'll find that what the price of this is the calls in this column. And these are the prices that you would pay for it. Right here, you can see that if you wanted to buy this stock on December the 18th, you could pay $20.55 and you would be able to buy it at $310. Now, you might be asking yourself, well, why the heck would I want to buy it if it's $285 today? Well, just imagine if it goes up to $330 or $340 and you could come back and you could buy it at $310. Well, you made a significant profit. The other thing is, as it continues to go forward, the way that some people make money on calls and puts is on actually selling the contract. if it is increasing in price, the closer that it gets to that date, if the price is over top of this port, the 310, which is called the strike price, if it's over top of the strike price, you're going to find this $20.55 for the cost of the contract to continue to go up. If it gets to December 18th and say, for example, that it had gone down, let's say it goes down to 275, which would be a dynamite price. If it goes down to 275, this contract basically goes down to being worthless. Let's, rather than beat this up too much, let's look actually at what some of the other analysts are saying on this so we can get through it. Most of the analysts out there are putting this price right at about 310, 320, right in that price range. The high price right now comes from an analyst at Key Corp, and they're saying they're putting a target price on Alibaba between 330 and 355. So let's say, for example, you buy in at this 285 price, sell it at 330. That might be something that they're looking for. The other portion that we're looking at, if you look at the yellow circle, you can see that Needham & Company has actually put a buy on this at 275, between 275 and 330. So right now they're probably buying at this point in time. So hopefully that helps you out just a little bit so that you can look at the stability of the company, the earnings, and the competitiveness. Go back and look at this video again and look for those three things. And if you can identify those three things in a stock, then you probably have a stock that's a good company. Now, I said at the very beginning that I really don't aim to teach you to buy stocks. I teach you to buy companies. And my philosophy is this, and this is just a rule of thumb. If you buy 10 companies and you have 2 of them that do excellent, and you have 2 of them that do pretty good, and you have 2 of them that do fair, you're probably going to have 3 or 4 of them that don't do very well. So the idea is to have 60% of them do above average or average, and that's going to get your overall returns up. So my job here today is to help you to identify those companies that are going to be profitable over the long term for you. Now, if there's a company out there that you have an interest in, put it into whatever platform that you're listening to, on YouTube or on Facebook or on Twitter. Let me hear from you. I want to know what kind of stocks are interesting to you. And if there's one that I can find information on, I'll be glad to put it into the daily program. I want to remind you, though, that I'm not giving you advice. I'm just trying to give you information and educate you on this. I'm not telling you to buy or to sell, but I want to help educate you on which companies are good companies to invest in. All right. With that said, I'd like to thank you for listening and encourage you to come back and listen again tomorrow. And stay tuned for the short disclosure, because it tells you all the fine print that's important to know. Have a good evening, and I'll talk to you. Well, hold on 1 minute. Okay. Hi, Edward from Prague. Nice to talk to you. Okay, well, that is about it. If you've got other information that you want to learn, let me know about it. I'll be glad to help you out. Okay, with that said, I'm going to end the evening and say have a good day or evening, wherever in the world you are.